Tu vois, c'est là que j'aimerais bien être un peu plus grande de temps en temps.
Sans trop petit.
Non, ça va, ça va.
Ça va.
Introduce next session titled The Importance of ESG in Value Investing, hosted by T.Rowe Price. And today with us, I'm very pleased to welcome Véronique Chapplow, ESG investment specialist at T.Rowe Price. T.Rowe Price is an active global asset manager with a strong heritage in fundamental research with specialization in equities, fixed income, securitized and municipal bonds. Véronique is part of the responsible investing team. As ESG investment specialist, she represents the group's ESG capabilities to internal and external stakeholders. Véronique, the floor is yours.
Thank you so much. Thank you, everyone, for being here. This is my first trip back to Luxembourg since the pandemic, so really pleased to be able to be here in person today. And yes, we're going to tackle this issue of ESG and value investing and to see whether they can actually happily sort of live together. Because very much on the surface, I think there's this preconception that the very nature of value investing is in contradiction with ESG. And the reason being simply that value investing is about investing in what is cheap, cheap relative to fundamentals, cheap relative to history, cheap relative to the market. It can be very deep value, it can be distressed value. And that means more often than not that you are taken into very corners of the market where there's a lot of ESG controversies. And also where economies are what we would call the old economies, and they tend to be quite high emitting. So I'm going to see if this works. And it doesn't. Do you know if there's something I should do differently? So what you can see on this slide is what I've just described, is that about 30% of the MSCI value index comes from 4 sectors alone. And these 4 sectors in aggregate account for about 56% of total global greenhouse emission around the world. So we're looking at utilities, industries, materials, sort of industrials. And I think there's probably a case for adding some of the transport as well, which is a 7%, which I've kept out, but where we also know that a large part of the transport sector would still be classified as value today. That's not the way it was meant to be coming. It was meant to be a bit of a build, but never mind. We will kind of take you through it. It's not surprised just to see that the market really started historically to buy into what is at the top left, is this idea that if you want ESG, you need to be green, you need to be kind of in this sort of mostly kind of growth stocks. By contrast, what we saw is that value tend to be classified as the brown and the ESG kind of unfriendly. But as you can see here and here, the narrative started to shift back in 2021 when growth stocks started to lose a little bit of their vogue and where kind of the value style started just to regain a bit of the initiative. And what's happened is that this value rally seems to be a bit more sustainable than a lot of market participants had assumed as well. So all of a sudden, people are starting to rethink that maybe we need to think about value and ESG after all. And the 4th and 5th image, which is the BlackRock one and sort of ESG taste on the right-hand side, is sort of starting just to show that really we're starting to see the emergence of a new narrative where actually, which is frankly overdue, where the 2 ESG and value can actually be very much be part of the same story, and that ESG doesn't really restrict itself to growth stocks after all. That was meant to be a build as well, but never mind. I think I will have just to take. What I was going to show on this one is really go back to basics. You know, what was ESG integration created to do? What was the intent and the design at the very root of ESG integration? Well, this is the ESG integration, the dark blue bubble on the left. It's very much about integrating environmental, social, and governance factors for the purpose of maximizing investment performance. It's very different from the second bubble on the right, which is the exclusionary screen, where you will decide to exclude certain sectors of the market, which in a lot of cases tend to be the value sectors, but where you really decide just that your values, your beliefs are actually taking precedence over your financial objective. And sadly, this is where most people actually associate ESG with that bubble. They really see it in the exclusionary screening bubble, when in fact it's considerably different. And it's also very distinct from sustainable investing and impact investing. I know you have some sessions on that today as well, which is promoting sustainable, positive outcomes. I'm starting to get the hang of it. But for ESG integration to be really truly successful, I think it's important that you have the right resource in place. And at T.Rowe Price, I think this is something that we've taken very seriously. We've decided just to build this capability, which is ESG integration, across all of our asset classes, with the exception of cash and money market sort of instruments. And as you can see on the slide, you know, we've got now a team of just under 30 people fully dedicated to ESG investment research. These analysts are kind of spread around the globe, not just in London, but also in Asia, in the US. And they are specialized by sector. They will conduct ESG issue analysis, but they will also conduct some very relevant thematic sort of ESG research as well. And the other thing that you need for ESG integration to be successful is a common language. You need to be able to compare different stocks versus each other in the same industry, you know, in your index. And this is what our proprietary tool is intending to do, to provide that common language. It's called RIIM, for Responsible Investing Indicator Model. And as you can see, we are collecting data across the three main pillars, E, S, and G, but also 6 sub-pillars, which you can see on the slide, and 23 different categories are on the far right. And for all of these categories in total, we're collecting 200 sort of data inputs. And that's allowing us just to cover, in total, 15,000 securities in a very standardized sort of manner. The other thing that we have done, which I think is also really relevant to do good ESG integration, is this, and to add to this consistency and scalability, is this materiality lens that we have also rolled out across our analysis. What we do here is that we fine-tune the weight of ESG factors at 159 sub-industry levels. And why do we do this? Because depending on the sub-industry that a company will find itself operating within, certain ESG factors will be much more financially material than others. So for example, on the left, you have an energy company, and you can see that the weight that we apply to the environmental pillar is 42%, considerably higher than for the software company on the right, where the environmental pillar only accounts for 27%, but where for this one, what is much more a driver of performance going forward is going to be the social factors, you know, retaining, recruiting, human capital, you know, those software engineers are going to be the blood of this company. So this is why it's really important just to have that added lens when you do ESG integration. And this is how RIIM, this is how we call it at T.Rowe Price, RIIM looks in practice. So there is a score, as you can see, there's a score that we ascribe to each issuer from 0 to 1, 0 being the best, one being the worst. But I think much more importantly than the score, I think it's just gives you this nice holistic kind of picture of the ESG profile of a company. It's important to always look beyond the score because you shouldn't be completely blindsided by an overall green score or, in this case, an orange score, which might give you the kind of the idea that the stock is okay, but you should always be aware that even within a green score, you could have some little lines of red that you, as a portfolio manager, should also be aware of. So some brownie points, maybe we can have a chat later on, for those who could hazard a guess as to which company this is. And as you can see, maybe a bit of a clue is that the product is causing some damage on the environmental side and on the social side. So maybe that helps to give you a bit of a clue. But I think to go back to my original point, I think what's important about ESG integration is that it's about scoring how management of those companies are able to mitigate and handle these risks on the ESG side. And therefore, you shouldn't necessarily score a sort of energy company worse than a software business. It shouldn't really matter. As you can see on this one, the energy company, yes, has got a much higher weight towards environmental factor than the software company on the right, but it showed us that it's actually very much capable of handling those risks properly and therefore scores well on that. And overall, you can see that the score on RIIM for this energy company is 0.49, not very dissimilar to the software company at 0.43. So both of them scoring green on our indicators. So again, maybe a few more brownie points for those who might have an idea about which is this energy company that is rated green and which one is the software business as well. And I think to further illustrate this point, that shows you the percentage of companies which are rated green overall in our kind of database. And you can see that if we look at this as to what proportion do they represent of the various indices, actually there's not that much of a difference between the MSCI growth and the MSCI value. Really, ESG integration should be leveling out those sort of style differences. And I think, remember, ESG integration should very much be style agnostic. But moving now into how does it work and how does it really help our value investors at T.Rowe Price? This slide is taken straight from their standard deck, so I was delighted to see it. I hadn't actually seen it before. But it very much sort of underlines areas where integrating ESG factors adds a really useful extra lens when you're a portfolio manager on the value side. The first one is providing you that forward-looking view. Many ESG factors, as we know, are sort of tail risks, are kind of long-term in nature, like climate change. And it's really important to be able to factor these factors and the externalities into our discounted cash flow models for some of these companies. The second one is collaboration and the importance of our collaboration between our responsible investing team and the fundamental investing teams as well, because it really allows us to go deeper into some of these individual sort of profiles. And, sometimes it's very specialized, things like green hydrogen, green steel. So being able just to work on these really complex sort of sectors is really important to do it together. The third one is engagement. Absolutely critical to be able to engage with value companies, because as we know, they are the ones we've tended to be really full of controversies, and we should also help them to disclose better, because they tend to be those where, unfortunately, disclosure is a little bit falling behind. But this is where I think it can really help us kind of push the agenda and encourage some of these companies to improve. And finally, this review piece that we were also put in place at T.Rowe Price. This is a quarterly meeting that we hold where the ESG team will sit together with the value team to go through their portfolios and check, it's a bit of a hygiene check just to see has the portfolio evolved over the quarter, just to make sure that not sort of new ESG risks have actually cropped up that maybe the portfolio manager is not fully aware of. And it also forms a good a way for us to kind of target some of our engagements as well. It's a bit temperamental. No. Oh, here he is. So what I'm going to focus on now is just to show you 4 areas where I really think that ESG integration comes into its own when it comes to helping, assisting value investors. So 4 areas, and I'm going to give you some examples of companies in these 4 areas as well, just to illustrate the points. The first one is the main pitfall that every value manager seeks to avoid, and it's value traps. Something that's going to stay cheap forever and ever. But the reality being that sometimes, more often than not, some non-financial factors will be the main reason, some ESG factors will be the main reason why these stocks should be staying cheap. The second one is, and this is where ESG engagement is particularly relevant, it is to help identify companies that are on the verge of improvement, that are really generally seeking to improve their ESG credentials. They have faced controversies in the past, but they're really trying to clean up their acts. The third one is something that it is not for the faint-hearted, but really pays off in spades in the long run. It is active stewardship. And this is where you can really help to unlock some unrealized value. And the example I'm going to take here is Japan, where we have really tried really hard to use our voice as an active manager to help sort of shift and push the ESG agenda. And then the last one is having some ESG thematic related knowledge to really help you unravel some good ideas that might sit in the value camp, but might make you some very good returns over time. These are quite busy slides, I'm afraid, but hopefully you don't have to read all of the text. That's one to avoid. This is in the value trap category. One that is unfortunately something that people will be mostly familiar with, I reckon, is Vale, which was involved in Brazil in this horrendous tragedy which caused the death of 270 people back in 2019 when one of their tailings dam kind of collapsed. And that's a good example of a company that has put in place some remediation measures. You could argue, that the safety standards have improved, that the ESG accountability is stronger than it used to be. It's also one where, 3 years have elapsed now since the tragedy as well, and which is still very much in the value camp, still having performed quite nicely recently, but still trading on 4 times 2022 projected earnings. But sadly, I think, well, not sadly, but I think our view would be, whilst it has improved from a very low base, it's still one stock that we would not encourage our portfolio managers to invest in. It still remains on what we call our conduct-based exclusion list, which would be the equivalent of the UN Global Compact exclusion list, because we feel that there has not been enough evidence as yet of sustained, prolonged improvement when it comes to safety performance. So we are monitoring, we're engaging, but we feel that whilst it looks good on the surface, it's premature to really be investing in it at this point. And you should also be aware that it fails our SFDR test of do no significant harm, and also fails on the good governance as well. So one that we could not invest in our Article 8 or Article-like funds, that goes without saying. Moving on to some of the improvers, and you have to stay with me that, I have to be slightly outside of my comfort zone here. We're not looking at very glamorous stocks here. But nevertheless, I think this is where I think it's really important just to have an open mind. This is, first one is the largest shipbuilder in China, and I'm not going to attempt to pronounce the name. But as we all know, the shipbuilding industry is historically been a really poor industry, crippled by overcapacity. But what people have not maybe recognized is that there's been a huge amount of consolidation since 2010. The number of shipyards across the globe has reduced from 1,000 to 285 in 2021. So it's an industry which is in a much better position today, and we might be on the eve of a very significant uptick in orders, maybe the biggest one we've seen since the great financial crisis. But obviously, you don't want to go into a reversal in cycle if the company is not really managed properly when it comes to ESG credentials. So this is where it's really important to do that due diligence as well. So on this one, I'm not going to argue. This is not a company, it looks green on the surface, but it's going to be one of the classic one where if you could see the overall ESG profile, there would be lines of orange and lines of red as well that we need to be very carefully monitoring. So this one has got the ambition to become the largest, the leading ESG shipbuilding company in the world. And for those who do not know, shipping contributes 2% of global greenhouse gas emissions around the world. Now, it's improving. As I said, it's not, the best in class as yet, but it is really now disclosing much more on ESG, which tend to be the biggest issue when it comes to that part of the world. It's got some proper scorecards, and it's also doing two really important things. One is retiring the sort of old and inefficient shipyards by really focusing on recycling and really trying just to build much lighter vessels, which is obviously good for greenhouse gas emissions, but also because they have been hit the whole industry by much tighter regulations, they are now launching LNG kind of powered vessels as well. So they will allow this sort of green transition towards sort of greener fossil fuels. Another one, which is probably slightly less contested because it's probably progressed beyond, the initial improvements. So there's probably a bit more evidence that it's definitely on the right path, is On High. It's a Taiwanese company that is supplying electronic components to the likes of Apple and Cisco and Dell, which again was hit by controversies in 2010 and beyond. But this is a really good example for us of where we've engaged continuously with the company, and we started just to see the company listen, take on board some of our recommendations. And that's why we were in the position in July to actually upgrade the score, and that allowed us to shift the overall RIIM indicator from orange to green. Now, it's a company that had controversies on the social side, so they are very much in the public eye. And what's happened as a result is it's really helped them to completely change the way they operate. And they have now moved from being laggards to being one of the leaders in the industry. They are now publishing some on our recommendations, maybe not just us, but I would definitely like to think that we have contributed towards this. Some key performance targets on the social side, that's on human rights. They're committing to some number of audits of their suppliers, some certification of their suppliers as well. But they have also released some very credible net zero targets, which have been substantiated by short, medium-term and long-term targets as well. But as I said, not all green, so we still need to be very vigilant, and that would be valid for all value stocks, I would say. On the stewardship side, this is the example of Japan I wanted to share with you. Japan is one of these countries which is a sort of perennial sort of value ground, but where there are kind of improvements which I think are really kind of moving the needle in the right direction, and where we can really help to nudge further as well. So two big issues facing Japan corporates. I mean, the first one is lack of board diversity. So for those who don't know, there were only 5.2% of board directors who were women in 2019 in Japan. So what we decided to do at T.Rowe Price is extend our gender guidelines, which is to vote against boards when it's a single gender board, and we've extended it to Japan. The other, and I would say, not just us, but it's good to see that in 2021, it was the first year where the majority of Japanese listed companies in Japan had at least one female director. I mean, we're not talking great, yeah, but from a very poor situation, it's definitely improving and moving in the right direction. The other big issue in Japan is poor allocation of capital via this sort of webs of cross-holdings on the basis that you're nurturing, fostering good relationships across the sort of corporate network. We think it's totally antiquated, that it ties up far too much capital and doesn't really realize any value. So that's another reason why this year we've started to vote against chairmen and presidents of companies where there's too much excess capital tied up in these cross-holding, and Mitsubishi Financial is one of these. So just wanted to mention that. Moving on now to the fourth area where I really think ESG integration is so super relevant. It's this bringing this extra insight to thematics. So this chart is actually coming from our fundamental value team, but this is where I'm going to show you that we can lay on top of it some of our ESG knowledge as well. And it really shows, going back to sort of shipbuilding, that we might be on the eve of a new capital expenditure boom that would really constitute a very attractive sort of long-term tailwind for value investors. So as you can see on this diagram, since the great financial crisis, value-oriented sectors like autos, base metals, industrials, have only invested at maintenance capital expenditure level. They haven't really invested for expansion. They haven't really invested for productivity. And we really think that after years of neglect, we could well be just on the verge of that environment completely flipping the other way. And there's sort of a number of reasons why we believe that, you know, this investment could start to go up. One is short-term, you know, there's inflation that we're all familiar with, and also fiscal spending, which really is going to help to target some of the investment into some of the areas. And if nothing else, the tensions that we're seeing currently on the geopolitical side really is helping and encouraging governments to spend sooner rather than later. And longer term, there is the trend towards deglobalization and towards sort of green transition, which is really also helping to accelerate the pace. And this is where I wanted to show you, you know, how much money could be really, how many opportunities, you know, in value terms could be created by this green transition. I think we've all seen different numbers floated around by different reports, and I think it's not the absolute that I'm really kind of interested in. It's just the order of magnitude, and as you can see, we're talking trillions. It's big. That's the reality. So if we are going to sustain, hopefully we do, what we currently spend on low emission assets and on those that are transitioning from high to low, which is around 3 trillion per annum, we're still going just to double. We need to spend an extra 3.5 trillion per annum if we are going to seriously be able to meet net zero by 2050. That's what the amount of money that needs to be spent in total. So I think it gives you an idea of the size, I would say, of the opportunity. But I think it's interesting to see where we should be looking for these opportunities. I think some of this reallocation of capital has already taken place, but as you can see on the chart, it's really been very polarized. It's concentrated on this very, very narrow pool of assets so far. What's been revalued has tended to be, I would say, in the easy kind of places, electric vehicles, solar, wind, all the renewable space. But where we think there is interesting opportunities is going down the profit pool and trying just to get more into those sort of value areas of the market where valuations are much more compelling, but will also allow you just to participate in these green transitions. And we go back to the sectors we've seen before: materials, capital goods, autos, and utilities. But again, I think I would hammer the point that not every company will be a winner. And this is where it's totally essential to be really robust in the information that you collect when it comes to the energy transition. And so you've got to be able to separate, what I would call, the wheat from the chaff. So what we have built, and if you remember, this is going deeper into one of the indicators within RIIM, and that's looking at sort of energy and emission and the sort of data that we collect. And this is actually something I would also highlight we do in-house. We don't believe that there's any information that's sufficiently standardized right now for us to be able to collect it from outside. So that's why we have to do this analysis ourselves. It might change in the future, but currently we feel you're better off really doing it on your own. So we will look not only at whether the targets are for 2050, but have they got interim targets in place as well? More importantly, the credibility of their transition path we will establish as well. We're going to see whether these targets are certified by the science-based initiatives. So all of this data is collected for all of the stocks that we are invested in, and then we convert them into what we call a net zero status. We can then determine if a company is achieving net zero today, whether it's aligned with net zero, whether it's on the path towards aligning or just committed, or maybe not aligned at all, in which case this is where we will really try just to use our engagement to get them to put in place some credible path. And I'm going to finish with sort of two examples of these sort of value stocks where you can, as I said, just participate in the energy transition without having to pay silly multiples. So the first one is a steel company based in South Korea. I did tell you it was not going to be very glamorous. So steel, going back to statistics, contributes 5% of global greenhouse gas emissions. We have engaged with this company numerous times, but what's happened is that gradually we've been able to upgrade the score. So you can see it's borderline green, yeah? Sort of the threshold for green is 0.5, so it's 0.49, so just make it onto green. So it's by no means all clean. But it's become by far the leader in the region for carbon intensity. It's also set a net zero decarbonization path. And what I would say is, yes, there are still controversies, especially a joint venture that they're finding it very hard to extricate themselves from in Myanmar. So that's why, we would want to continue to monitor this stock. But one for the brave and fearless, maybe one to be looking at. And the last one is a glass company. It's actually a company also based in China that makes the windscreen, that makes the windows for cars. So going down the profit pool, but what it's doing, it's integrating energy efficient sort of measures, features in the way that it builds these windows, much more lightweight materials, which means that it starts just to sell much more to EV manufacturers, because it's really important to be selling kind of light materials. It helps you just to use your battery for longer and travel further as well, which is really important. And you might or might not have seen this film called, it's a Netflix documentary called The American Factory, which featured this particular company. And just to show you, it's not without controversies. They took over a plant, a General Motors plant in Ohio. I think it was back in 2017, at a really kind of difficult time. But it shows the challenges of, integrating Chinese culture in the US, and that was definitely not straightforward. And it's another company where it's actually still orange, as you can see. There has been improvement, but and especially on this sort of social side, but within the environmental side, the product is getting better, but we would really like them to move towards sort of international best practice when it comes to disclosure and other things. So it's one, that's definitely got scope to do better in the long term. And before I finish off, another question, and I didn't really do it on purpose, but I don't know if you've identified, the common thread between all the various examples that I kind of used in the presentation. It was a bit of an outcome of my work, but you might have spotted that they're all based in emerging markets. And that was not intended. It was just the results of me preparing this presentation. But I think it's also interesting that emerging markets value, they really go nicely together. This is really the place, I think, where there is scope for ESG standards to improve. Disclosures usually lagging the rest of the world, but where also you can identify totally underappreciated opportunities. And the last words I was going to leave you with, and beware, I'm not a macroeconomist, so I'm not going to pretend that I know it all, but there seems to be this convergence of three interconnected agendas, which seem to really be supporting kind of value investing for the long term. The first one I've touched on quite a lot already is the green agenda, which is a secular trend, but really should be quite inflationary with a lot of infrastructure spend. Remember this 3.5 trillion that needs to be spent every year between now and 2050. The second one is the social agenda, which is also inflationary, where governments since COVID, and that's creating a new precedent, have started to hand over some cash to population to really be able to avert sort of crisis. And I'm not saying it's going to be repeating itself anytime soon, but definitely something's changed here. And the third one, which is this, I've described it as the self-sufficiency agenda, which is something that started with COVID, with supply chain disruptions, but I think has been accelerated with the war in Ukraine, which is this need for security of supply when it comes to food, when it comes to energy as well, which is also in itself inflationary and will really require a lot of investment as well. So all of these mean that whilst value might have been seen in the past as something that nobody really need to care about, we might be actually having to revisit. And as I hopefully demonstrated, ESG integration can really help you to do a good job in terms of assessing the winners and the losers. So I'll stop here.
Thank you, Véronique, for your excellent speech and for giving us hope, even to bring all these companies to the sustainability transition. So do we have questions? Anyone who would like to ask a question?
Your examples were from emerging markets, and emerging markets is where the data challenge, the majority of the data challenges come from, because they are maybe less equipped to collect the data, or it's less easily available. How do you handle that challenge?
Yeah, so if we go back to RIIM, maybe no, it doesn't matter. This is where we have the ability, when data is not available, to populate the template ourselves. And this is where active management is so important, to be able to have that research resource to actually go and try to get the data that you need. A lot of the time, actually, we find that it's not as if they don't have the data, they just don't recognize how important the data is to us. And this is why engaging is so useful, to kind of try to explain to them why we need to have access to this data. And it takes time, you know, it's not immediate. But, you know, like a company like On High, for example, we've really taken on board a request for more data. Even the likes of Alibaba, you know, which is like a big stock, we felt disclosure was really poor, and we've really kind of engaged numerous times, and things have improved. So I'm not saying I can wave a magic wand, it's all going to get better tomorrow, but this is where it's also creating opportunities, I would say, if you're willing to spend that amount of time to really kind of fill the gaps and be able just to kind of not only engage, but also help just to get this information into your spreadsheets.
Thank you. Any other question?
Now, did anybody guess which was the first company on RIIM, or did anybody have I can give the answers now. So the first one was Total. That was an oil stock, and it's one that, you know, does okay, but still has some areas of red, as we've seen with the product. The energy company that was rated green on RIIM was Equinor. We think this is the Norwegian oil and gas company. We really think it's one that's mitigating this elevated ESG risk in the best possible way. And the software company was Microsoft, so that you know.
Can you give us some idea, how do you choose those companies, basically, according to your methodology? Depending on the country, depending on, do you have targets, specific targets?
Are you talking for the value portfolios?
Yes.
Yes. Well, ultimately, it's the choice of the portfolio manager. Working in the responsible investing team, I can only advise. So they would normally come to us just to check that the RIIM profile is still as it should be. You know, just want to make sure they haven't really missed anything. I would say portfolio managers tend to be a bit more risk takers, maybe, than the responsible investing team. We can't impose our views. You know, if it's deep orange and they still feel comfortable owning it, it's entirely up to them. But we're here to guide them, just to support them to make sort of better choices. And, you know, I think, you know, they will try to have sort of a balanced level of risk. Also, what I would say is I've tended to really show you examples of value in these very deep pockets where it's high emitting, but value can be in all sorts of other ways as well. You know, I haven't looked at areas where, you know, maybe the company has had a huge transformation, but it might not sit in one of these sectors, and there's a lot of uncertainty as to where it's going, and it's been out of favor because of that. So I think value is not just about, as my PM would say, it's not just about airlines and chemicals. You know, it takes you to all sorts of different places, and you can actually build quite a defined portfolio with it. This is not giving you the overall picture.
As many as you can.
Can you talk, I want to come back to the weightings between the S and the G, and maybe I missed the beginning. I missed the beginning of your presentation, so I might have missed this. If I looked at some of the examples you had, the percentage that you give to G varies depending on the different sectors. And I would have thought that the percentage weighting that you should give to G should be the same, whatever the industry, whatever the sector. Can you give us a bit more detail on that?
No, it's a very valid question. see it as governance is always important, absolutely paramount. Actually, I think it really drives everything else, the E and the S. You know, if that doesn't start from the G, then it's an accident waiting to happen. But we use this materiality lens. So we use something equivalent to the SASB materiality framework, where we will kind of change the weight that we apply to different ES factors, depending on how financially important they are for a company. And we've taken it a stage further, that SASB is looking at sort of industries. We're going deeper, we're going sub-industries. And I think that the reason being that we think that for an energy company, you know, the environmental side should really be kind of paramount. They need to be on top of that risk. This is the area that they need to mitigate the most. This is not to say the rest is not important. We will track it as well. But relatively speaking, you know, this is where most of the risks, you know, we should start with that. And that's why I'm just saying, what will be in governance will be, you know, the residual, but it doesn't mean to say we don't look at it. We always look at it. And that's why also, I don't want you to think, that's what I was really explaining, it's not just about the score. The score is, I'm not saying meaningless, but what's really critical is to have the overall picture and to look, in governance, do we have issues, you know, and have we engaged on some of these issues? That's just as important as you know, being green elsewhere. So it's really, as you said, absolutely critical just to do that too. And we have 4 people working full-time, you know, on governance, and yeah, they do a fantastic job at, again, scrutinizing, you know, every company. We vote on everything that we possibly can. It's a lot of work, but it's absolutely critical to doing a good job.
Thank you. Anyone else? I don't know if online, I think we have no question also online. So, I would like to thank you again, Véronique and T.Rowe Price, for hosting this session.
You're more than welcome. Thank you very much.
I'm now pleased to invite you to the lunch at the Modem Café, and we'll ask you to be back on time at 2 p.m. for the session hosted by Morningstar and focusing on understanding the ESG fund landscape. So please see you upstairs at the Modem Café for the lunch, and later on for the first session of the afternoon, the Morningstar session. Thank you.